Well, good afternoon, good morning, and good evening, everybody. We have quite a number of people joining us from all over the world today, and particularly, of course, from the APAC region. So welcome to BDO's second in the global series, Transfer Pricing Perspectives from Around the World. And of course, today's focus is a spotlight on the Asia Pacific region. I'd like to just run through some housekeeping initially before we move into what our discussion topics will be. For those of you that haven't been joining a BDO webinar before, we are using GoToWebinar. So you will be muted, or you are muted, so you can't ask questions verbally, but you can submit questions through the question mark on your question panel on the platform. So please do ask questions, and we will try and address as many of the questions as we can during the session. We'll also try and leave some time at the end of the session. It's great to get questions, and it's also great to answer them as we're going so that it's in context and it's relevant to the discussions we're having. So please do ask questions. After today's session, and in fact after the global series, you will receive an email from BDO outlining a link to the recorded sessions, the slides, presentation slides, and also our contact details, and of course access to past and future webinars. And that will arrive after the last in the series, which is on December the 1st, which is the Americas session. And if you are not already registered for the Americas session, but you would like to register, please do let us know, and we'll be sure to ensure you can join that, or you can refer it to a colleague in the Americas region if they're interested in joining. So I'd like to introduce you to our panel. My name's Zara Ritchie. I have the pleasure of being the National Leader for BDO's Transfer Pricing Practice in Australia, and I will be your moderator today. And joining me on our panel, I have a distinguished group of partners from the BDO APAC region. So we have Bernice Tan from Malaysia, Dr. Enoch Siu from Hong Kong, Elise Tan from Singapore, Jiga Saya from India, and Michelle Mianova from Indonesia. And unfortunately, we have all of our names in front of our faces, so you do know who all of us are. So let's move into what are the discussion areas that we're going to cover today. So we've broken it down into three sort of sections. So the first section is really practical solutions and issues that we know you're all facing in dealing with COVID-19. We're going to look at local developments and guidance around COVID from tax authorities and the OECD, year-end planning and housekeeping matters that some of you may have already started to consider, but what do you need to consider before year-end? And what sort of audit activity do we expect to see, or are we already seeing across the region as tax authorities realise that, you know, COVID is going to be with us for some time to come? So whilst they've been empathetic to date, what are they actually starting to plan, either in response to COVID or just business as usual? And finally, we'll finish off with some commentary in relation to taxation of the digital economy. We won't spend a lot of time on this, particularly on Pillar 1, Pillar 2, because many of our clients tell us, well, look, it's still, you know, at least 2 years away. So it's not something that we're spending a lot of time on. So we're just going to touch on that, but we're going to spend a little bit more time providing some commentary in relation to some of the other digital service tax regimes that are already either in play or currently being implemented or planned for implementation, not just across the region, but globally. And Jiga's going to talk a little bit more to that when we get to that. So, so moving into our panel discussion and questions, I think perhaps without further ado, we'll move straight into it. So the first of our series of these global webinars was run last week, and some of you may have participated. So it was a European webinar, and in that webinar, it was pretty clear as well that tax authorities across the EMEA region are waiting for the OECD to issue their guidance in relation to what are some of the specific issues and guidance is what might be coming from the OECD, what are some of the tax authorities thinking about. And it's pretty clear that most tax authorities around the world are just waiting, watch and wait until the OECD issues their guidance. So we thought that we'd at least start with this in today's webinar and talk to what are we seeing across the APAC region in terms of either existing guidance or expected guidance. And I'm going to ask the panel in a moment to respond to that question. But before I do, maybe if I just set the scene from an OECD perspective, and then I'll kick off with some comments from Australia, which I think is leading or has been leading the charge with their sort of transparency measures around COVID-19 guidance. So I think there's a lot of people, both business and tax authorities, who are waiting for OECD guidance, as I said before. So what do we expect from the guidance? Well, we might be a little bit underwhelmed if you're expecting to get a whole series of examples or answers to all of your complex questions, because bearing in mind the OECD can't provide anything other than guidance, and the guidance is for taxpayers and tax authorities, who then need to interpret that guidance and how that guidance should be applied in a given situation or in a given jurisdiction. So if you've got any particular difficult issues, you may need to actually speak to your local tax authority, either formally or informally, if guidance or your advisors or your internal discussions don't provide the answers that you need. And let's face it, no one has all of the answers in response to COVID, because we haven't been in this situation before. So there's so much uncertainty. And I don't think the OECD guidance is going to be the answer to everyone's questions, unfortunately. I just don't think it can be. So they're certainly not going to introduce any new guidance or new principles. The structure of the guidance will come as an FAQ, or frequently asked questions format, which is unusual, which is unique to the OECD. It's not something that they typically do. And so the intent is that those FAQs should allow multinationals to at least try and align or visualize, your own circumstances with some of the scenarios or issues that the OECD is calling out. And hopefully that will give you some level of guidance. For example, we expect that they'll make some comments in relation to financial impacts, intercompany financing, impact of government support arrangements, what to do with benchmarking or comparability, of course, and we'll talk to some of this in a bit more detail ourselves. And then finally, documentation, expectations, and or gathering of evidence to support your positions. I guess a final comment on the OECD guidance, we're not expecting anything before early to mid-December. So, it really isn't going to give you enough time to respond if you haven't already started thinking about it now. Just to kick off discussions, as I said, so from an Australian perspective, the tax authority, the ATO in Australia, takes quite a transparent approach to most things. And so in the context of COVID-19 and in response to a lot of questions that they were getting from advisors and taxpayers alike, in June, July this year, they issued a series of documents and guidance to just provide a little bit of transparency and guidance to taxpayers, giving you a steer in terms of what the ATO's expectations were in terms of how your transfer pricing arrangements should be managed in the context of COVID. So they released some commentary in relation to the treatment of government assistance. So that has been a bit controversial for some, because the tax office in Australia has indicated that generally it wouldn't be arm's length to share government assistance with related parties overseas, unless you can demonstrate that that's what other third parties are doing, and find evidence where other third parties might be doing the same thing. Otherwise, the ATO would expect that the local entity that receives the assistance keeps the assistance and doesn't share it with the international related parties. They made some comments that I think are kind of obvious or expected in relation to what economic analysis and evidence you might need to prepare to respond to your positions. And I know some of the panel members will comment on that as well. And the importance of having pre and post-COVID analysis and looking at sort of but-for or what-if scenarios in the context of a with or without a COVID impact. Very strong views from the ATO, which I think are indeed echoed by other tax authorities, around expectations that there wouldn't be substantial changes to contracts or legal agreements or allocation or responsibilities of risk in the context of COVID, and there'll be a very, very close analysis of, in substance, what roles and responsibilities and functions and risks is the entity responsible for, and whether that's been, I guess, modified intentionally in response to COVID. So we'll be looking for that. So we do expect that the OECD guidance is going to be broadly in line with the ATO views, or the ATO views are going to be broadly in line with the OECD guidance, whichever way you look at it. But the ATO, as with a number of other tax authorities, are part of the OECD's working party that's looking at the OECD guidance. So, so that's just a little bit of context setting. So I know that most tax authorities haven't said a lot about COVID-19, but Elise, I think Singapore has given some guidance or commentary. So maybe we could start with you, if you could make some comments from a Singapore perspective, please.
Yes, Sarah. The Inland Revenue of Singapore has issued some guidance on COVID back in September. So first of all, they clarified the additional evidence required to support COVID-impacted transfer pricing outcomes. Second, similar to some of the other countries, they have also defined their expectations of APAs. So they generally accept that there will have to be more flexibility and that communication is very important. Third, the IRS introduced a concession for term testing for financial year 2020. So traditionally, IRS has only accepted annual testing, meaning that you test the financial outcome of that year against the benchmark arm's length range. Under the new guidance, they have now allowed a once-off concession for taxpayers to apply multi-year testing of the tested party results if the taxpayer views that the annual testing approach results in volatility. So this proactively giving the taxpayers the choice to adopt term testing is a big step for the IRS. It reflects that they know COVID is an exceptional event and they want to help taxpayers comply, at least from a Singapore perspective. So, and lastly, as you mentioned, the ACO has issued guidance on the treatment of government assistance. But on this topic, the IRS is still sitting on the fence. They have not taken a position on this one.
Thanks, Elise. Bernice, what about from a Malaysian perspective? Any additional comments?
A very good afternoon, everybody from Malaysia. There are two areas of interest in terms of COVID-19 guidance from the Inland Revenue Board of Malaysia that I would like to share with you today. One is on APAs, and the second thing is on positioning within the range. On APAs, there has been an FAQ that's been issued. So if you have any new applications that you wish to submit to the revenue authorities, and there has not been any impact to your business from COVID-19, you are welcome to submit that application. However, if there has been a substantial impact to your business, then the revenue will not be considering your application at this point in time. Secondly, on existing APA applications that have been submitted pre-COVID, the revenue has stated that you are not allowed to change any of the conditions that you have put in for now. However, some concession may be considered in respect of a term testing. So they may allow term testing with any adjustments, compensating adjustments to be made at the end of the APA covered period. Again, this is only on a case-to-case basis. So the third point is on existing APAs. Okay, no changes are allowed in terms of your critical assumptions. You are still expected to comply. However, if for any reason you are unable to now meet the critical assumptions, you should get in touch with the tax authorities. Okay, an interesting thing to note from Malaysia is the relaxation of positioning within the arm's length interquartile range. Now, generally, the Inland Revenue Board expects taxpayers to earn around the median result. So meaning if you have a lower quartile result for the year, they will adjust you to the median position. However, for 2020, if you use a 3-year weighted average result, meaning using 17, 18, and 19, and your result falls anywhere within this range of results, the revenue is willing to accept that this is an arm's length outcome. However, if your result actually falls below the lower quartile, you are expected to wait till the end of 2020 results for the comparable stats. So once the 2020 results are available, you will have to do your testing accordingly. Okay, so this is a major concession, I believe, for the tax authorities to allow this for Malaysian companies. The other point is similar to Singapore. The Malaysian tax authorities have not actually reached a position on the treatment of subsidies for transfer pricing purposes. So that's all for now from Malaysia. Back to you, Zara.
Thanks, Bernice. I think one of the most interesting comments from a Malaysian perspective, and I heard one of the Malaysian tax authority representatives make this same comment at an event that I was at, well, online, digitally, last month, or September it might have been, but it was a flippant comment that was made, but I think you've reinforced it, Bernice, in your comment. But what they said was that they will look back in 1 or 2 years' time to determine whether the transfer pricing position adopted by the Malaysian entity was correct according to the comparables. In my view, that's hindsight, using hindsight, and it concerns me enormously that rather than relying on or allowing taxpayers to rely on information that's available at the time to make decisions, the tax authority is already sort of putting its hand up and saying, well, actually, we are going to go back and have a look once we've got financial data for other entities. So I'd be interested if perhaps some of the other panel members might like to comment on that, and whether your tax authorities are likely to take a similar approach, because I think that's something that we will be pushing back on, pretty strongly. Particularly, from an Australian perspective. So maybe, Jigga, can I go to you? What's some of the specific guidance or commentary from the Indian tax authorities?
Sure. Thanks, Zara, and hello everyone. So I think Zara, you spoke about hindsight. We face this challenge every time. Whenever we go for a transfer pricing audit, tax authorities in India, ask you to re-benchmark using the current data that is available for the relevant period. So the position they've been taking is contemporaneous, means the data, not the data, but the transaction should be present during the period, or the entity should be present during the period. Subsequently, it's only data which is released. So they've been using this hindsight. Talking about COVID guidance, currently no guidance around COVID on transfer pricing, whether to do with treatment of subsidies or whether to do with adjustments, how they're going to treat losses. No specific guidance. However, I think they've been empathetic towards the position about the uncertainty. What we've learned from our discussion with APA authorities is that they're happy to distinguish between 3 periods: pre-COVID, COVID impacted period, and post-COVID. Again, they've not been very strict about implementing critical assumptions. Of course, you need to prove how the disruption has affected you and how relaxation of critical assumptions may not impact the APA in a negative manner. But that's about it. I think a lot of taxpayers would rely on some past decisions. When you talk of, say, subsidies or grants, there have been past decisions, not necessarily around, but when we've received subsidies from parent, there have been cases which say that they have to be included as part of your operating income for the transfer pricing analysis, and there are several other decisions. The transfer pricing judiciary in India is evolved, so I think people would rely on some of these decisions while they make adjustments.
Thanks, Jigga. I might go from India to Hong Kong, China. Enoch, would you mind sharing what you're hearing, seeing, or not hearing or seeing?
Sure. Hello, everybody. In Hong Kong, there's a lot of particular transfer pricing guidance with respect to COVID. In particularly Hong Kong, this is only our second year full year that we have a official transfer pricing regulations, even though arm's length standard and OECD approach has been adopted. So with respect to what we were talking about in benchmarking, how to handle these kind of analysis in this very extraordinary year, adopting the OECD approach, going by what the OECD guidance is all about, to determine the arm's length nature of all the transactions in Hong Kong, I think that's key, that's important. How are we going to go about to do it? I think everybody is throwing up their hands and say exactly how to deal with this year to call it true arm's length. We do not know, but I would say the IRD always pride itself as being reasonable, and I think they have been so far. So going by the OECD approach to obtain arm's length, the nature, determine arm's length principle, that would be key. From a China perspective, we actually had met with the STA in September, and the SAT reiterated that in terms of COVID guidance, they are only going to go with the PE and tax residents opinion they have issued in August, and no more transfer pricing guidance so far. But from a China perspective, I just want to raise one thing, is that there has always been a specific guidance on special factor analysis in the transfer pricing analysis, that a lot of taxpayers in China, they would use it when they fall outside the range or below the median, that they need to do something to say that we are arm's length. Although this is a fairly subjective analysis, but it's in the regulations and it can be used. So I would suspect that a lot of taxpayers and a lot of consultants actually would go ahead and use special factor analysis to talk about this extraordinary uncontrollable factor that is outside of the business operation of the taxpayers. Back to you, Sarah.
Thanks, Enoch. Last but not least, Michelle, from an Indonesian perspective.
Yeah, okay. Thank you, Sarah, and hello, everyone. From a transfer pricing perspective, there are three things that I would like to share today. One is around the new regulation for APA, which was issued in March 2020, and its implementing regulation was actually just issued in September of 2020. Based on this regulation, we know that the ITO is now open for renegotiation of APA terms, where taxpayers already know that they will not be able to satisfy their APA terms. Any special factor adjustment are now allowed under the new regulation, where taxpayer financials should be reflected in the COVID-specific form that is attached to the September 2020 implementing regulation. While this appears to allow taxpayer to make special factor adjustment that the ITO often had not accepted in the past, we will need to see how this will be implemented in the future. Secondly, on MAP, a mutual agreement procedure, now the tax office has offered time extension for MAP requests that have not resulted in a mutual agreement within a 2-year timeline. The third one is around benchmarking, as what the others have shared, that the tax office has indicated that they will be a little bit open now. They're not as rigid as in the past, that you can use, for example, if in the past you have used private companies, now you can use public company within Indonesia to support your benchmarking result. Multi-year testing, unfortunately for Indonesia, is not possible because the taxation system in Indonesia relies on the year-on-year basis. Loss-making companies may also be considered by the tax office, and broader search strategy, for example, expanding your geographic criteria to include other countries, for example, US or Europe, it also can be accepted. Those are the things that you may want to consider following the COVID pandemic. Back to you, Zara.
Thank you, Michelle. So I think it's fair to say that there isn't a lot of guidance in the APAC region either. And time will tell, I guess, in terms of how different tax authorities interpret responses taken and positions adopted as a result of COVID. I think probably I'd leave the participants with two messages. One is, don't wait until you receive the OECD guidance before you start to, plan and prepare for what adjustments you need to be making to your transfer pricing arrangements for 2020. And also bear in mind, you're going to have to consider 2021 as well. And let's hope we don't have to worry too much about 2022. But certainly we're going to be, under the COVID wave in 2021 for a period of time as well. And the second, I suppose, key message, which is kind of in conflict with the first one, is just be very mindful of very significant year-end adjustments and make sure that you have got evidence and support behind that, because the larger an adjustment at year-end, the more suspicious a tax authority will be. And that's not to say that you shouldn't be making them. It's more that, just be very cautious about being able to support the adjustments that are made. And then also be mindful that if you haven't booked an adjustment for accounting purposes, there will be some jurisdictions where you may not be able to seek a tax deduction if it is a reduction in income or an increase in expense, for example. So just be very mindful of what the domestic law already provides, and don't expect too much discretion around that, or any actually, in response to COVID by the tax authorities. So we're going to move into our next topic. So we want to talk about year-end considerations and adjustments to TP policy. So as we do that, I'd like to ask Kate to bring up our first polling question, which is going to ask participants to respond. We've got 3 polling questions. So this first one is in relation to changes to transfer pricing policies and pricing arrangements. So there's the poll. If you could please quickly respond to the polling question. Do you plan to or have made changes to your TP policies to reflect changes in the business resulting from COVID? Yes, no, or not perhaps sure at this stage. Okay, Kate, let's bring up the results. Okay, so it's interesting. It's probably quite similar to what we saw in EMEA. So the results in EMEA were that 59% of clients responded that they hadn't yet made adjustments and they were still determining if changes are required. And APAC responds, you're saying 47% here, so not dissimilar. So half the group are still thinking about it. And I think a lot of companies are, close to year end, assuming 31 December, unless you're in Australia, of course, and there's quite a few 30 June year ends. And of course, there's March year ends across the region as well, but a very, very large majority with December year ends. So it just goes to show how much uncertainty there is and how much complexity there is in terms of actually what do you need to do in responding to the impact of COVID. So let's move to that discussion, I guess. I think I'd like to start with you, Bernice. So what type of adjustments to transfer pricing policies or pricing arrangements are you discussing with your clients? And perhaps if you could share some insights with the group today, please.
Yeah, sure. Yeah, a lot of my clients are actually taking a wait and see position. So they're not, they're waiting for guidance from the OECD, which is a bit worrying, because I think we heard from Zara just now that they will be underwhelmed. It's likely they'll be underwhelmed by the OECD guidance that will be provided. So a lot of companies, we can expect them, especially those with a 31st December year end, there will probably be a mad scramble to do year-end adjustments just before or after their year-end. Now, in Malaysia, we have companies from quite a diverse range of industries. Broadly, we can categorize them into essential services and non-essential services. Coming from essential services, we have rubber glove manufacturers. Okay, so these companies, Malaysia is the world's largest exporter of rubber gloves, and as you imagine, COVID-19 is a bumper year for these companies. So such companies are unlikely to require any adjustments to their transfer pricing policies, obviously. But on the other hand, we also have companies in non-essential services, companies like in the hospitality industry, and Malaysia is also home to many contract manufacturers that were really badly hit by the disruptions to their supply chain, especially in the early part of this year. Now, these companies are companies that really need to relook at their transfer pricing policies to see if adjustments are required. The other point that I wish to share with you is that you have to be careful when you put through large adjustments during the year, especially towards the end. And the Malaysian tax authorities are generally not very, they are suspicious when you put through large year-end adjustments, especially adjustments that take away profits from Malaysia. So with that, you have to manage this transition very carefully. In all circumstances, when you have low margins or losses, you need to make sure that you build an appropriate case for your company accordingly. That's all from Malaysia, Zara. Back to you.
Thank you so much. Who would like to go next? Jiga?
Yeah, thanks, Sarah. So I think, when we talk of changes, I think as Bernice mentioned, there are a variety of industries and everybody reacting differently. I'd speak about something which is most impacting some of our clients, which is the low risk entity or captives. Where low risk entities.
No, sorry, we lost you there for a minute. Keep going.
Okay, sorry. So talking of low risk entities, captive service providers, I think within the group. They continue to operate under the financial garb of the parent company. However, in the current situation where the support is that the parent company can provide has been restrictive due to groups struggling with limited means to keep the business running. So in light thereof, I think it is important for the companies to evaluate whether they should reduce margin for such risk and insulated entities, or should they continue with their existing markups. Similarly, in cases where affected subsidiaries are generating losses despite having routine functions, say contract manufacturers or limited risk distributors, primarily due to insufficient productivity or slack in market demand, they need to evaluate whether the principal entity should bear the same, or whether it will stand good from an arm's length principle, or should they allocate the losses as well. I think the company should also, while they're doing, I've had several discussions where companies now are restructuring their supply chain, and maybe we can discuss that later. But they should evaluate this part. And on the other hand, I think it is very important, in the current period, that businesses that have been, paying management fee and royalty in the light of the current situation, whether they should continue paying at the same level, or they should be relooking at the royalty and management fee agreements. So these are some of the discussions we've been having with our clients in India.
Thanks, Jiga. Enoch, anything specific to add?
I think it's very similar to what Bernice and Jiga was just talking about. Here in Hong Kong, China, many of the MNEs, the big multinationals subsidiaries located in this region, most of them are captive or what we call routine entities, like contract manufacturers or service providers. But we also see that there are quite a few of the headquarters in the Americas or in Europe. They are looking at changing the group's pricing policy, so that these subsidiaries are not going to receive the same profit they used to receive pre-COVID. So when we're looking at these kind of policies, the headquarters are going to say, yeah, we're going to revamp the entire role and responsibilities of all these subsidiaries. so that we can justify the change in TP mechanism. Is it true? So I think these are the genuine questions that we need to be very careful, even though we're saying that the functions, assets, and risk may be changing, but is it only changing for 1 year? Is it going to be, why are we changing it? What's the justification for that? So these are the things that we have been discussing with these multinational enterprises when they are exploring changes in their pricing policies.
Thanks, Enoch. Michelle?
Yeah, sure, Sarah. Similar to what Bernice had mentioned earlier, most taxpayers for Indonesia are taking a wait-and-see attitude before they make any changes in their TP policies. Some companies that are more conservative decide to make adjustment on a monthly basis instead of year-end, especially when the related party transaction attract other type of tax, for example, withholding tax and VAT, as any payables for withholding tax or VAT are due by the 10th and 15th of the following month. So they have like a 30-day window to make any changes if they need to. The second one is on intra-group service transaction. Some companies that I've seen have revised their agreements to include online meetings, video conference, and other electronic correspondence in the means to deliver their services, noting that deduction for Indonesia will only be granted by the tax office when there is enough evidence that the services are actually rendered. The last one that I would like to raise is on intragroup financing transaction. Any changes in the contractual terms before and after COVID, for example, reduction of interest rate, providing longer repayment terms, or even grace period, must be documented in a robust way. And it must also be evident that it reflects the arm's length principle. So the ITO is also taking a view that excessive funding, this is just lately, that excessive funding will be viewed as capital contribution, which that means that you will lose deduction and also attract withholding tax.
That's harsh, isn't it? So that's a really, really important message. Thanks, Michelle. Elise, you get the final say.
Hi, okay. So at my end, I see some clients who are taking a wait-and-see approach, but there are some others who have, for example, started to renegotiate and update their intercompany financing arrangements. So there are many treasury hubs here in Singapore, and also many companies say that on land to group entities. So with COVID-19, some of these companies have started to review the contracts, the financing contracts, changing the interest rates or repayment terms, or setting up deferred payments as necessary. For these companies, any changes that they put in should be done with reference to what third-party banks are doing in order to support that they are at arm's length. So the other observation I have is that in the past, regional offices here would typically charge for regional cost incurred at the markup out. But with COVID and group operations being adversely affected, we see a lot more negotiations around the type and amount of charges that recipients will accept. And there's even disputes as to whether the regional services benefit the other entities. So this is an area that I think has been managed carefully, because traditionally the IRS has had a track record of going after head officers and regional officers that do not charge out the proper amounts. Back to you, Zara.
Thanks, Elise. I'm just going to make 3 sort of quick comments and then we'll move on to the next area. So firstly, I would say in terms of picking up on the financing arrangements, I think it's fairly clear for most tax authorities that they will comprehend a deferral of interest, but they won't comprehend an interest-free period. So that would not be considered arm's length. Second point I would make is that if you are a subsidiary of a multinational and TP adjustments are being analysed and proposed out of headquarters, you need to make sure that you understand the impact, how those adjustments have been determined, and what evidence, underlying evidence or analysis is going to be available to support the position when your tax authority comes knocking on your door. And if headquarters decides to go ahead and make the adjustment without having all of that necessary underlying evidence or support, my advice to you would be to make sure headquarters is aware that they're going to need to be accountable for any flow-on consequences in dealing with those challenges or inquiries from the tax authorities. So I think there's a really important accountability for adjustments that are made here and underlying evidence and analysis to support decisions that are made, particularly but not limited to limited risk distributors and service providers and the like that Jiga referred to as well. So just be cautious about that. The third point that I'd make, this is my slightly more controversial comment, and that is that there is a discussion looming in the industry around whether pandemic losses should be considered as a result of the decisions made by a principal. So, for example, in a situation when you have a limited risk distributor and you have a principal, limited risk traditionally earns lower margins, fixed margins, principal has residual profit and or residual loss. But this scenario is quite different because it's not as if the principal has made a decision to shut down operations or businesses in a local jurisdiction. Governments have been shutting down businesses, particularly those bricks and mortar businesses. So there is a question mark over whether losses should be borne by the principal or whether losses should be shared between the principal and the local entity, where losses have arisen as a result of local government decisions arising from maintaining the health and well-being of the community versus continuing economic success of the local business. So I think it's just worth raising that. It's a really difficult question to answer, and of course it's going to get a lot of pushback from tax authorities, and it will be debated in the years to come. But I guess it's just something to put out there on the table to say, not sure necessarily that we have all the answers to this, or that the OECD position or the local tax authorities' positions are necessarily correct. A lot of them will be very self-serving, of course, as we know. So just something to be mindful of, and perhaps pick up that conversation with one of us or your advisor. So let's move quickly into, I'm conscious of time, so let's move quickly into just some quick tips. I'd just like to ask if anybody on the panel has some quick tips for some year-end transfer pricing housekeeping that companies should be considering before year end. So Michelle, perhaps if I could start with you, a couple of quick tips from you, please.
Sure, Zara. So as we are approaching year end, I would suggest a couple of things. One is that because Indonesia adopts the ex-ante principle, the arm's length principle is implemented based on your forecast data. Before you file your 2020 annual corporate tax return, I would suggest to do a gap analysis between your forecast and also the actual result by year end for 2020. Any gap identified would be your key soft areas, and then assess the level of robustness of your supporting evidence of these key soft areas and complete them where time permits. Another one is that based on your gap analysis, if you make any special factor adjustment, to show that your business is business as usual in comparison to the after COVID hits, make sure that the analysis is supported by evidence and adopt an approach that is simple and straightforward. The last one, I think this is a little bit of controversy in my view, is around a true up and true down adjustment that is currently, many of the subsidiary of European and American has adopted. This mechanism, true up, true down mechanism, is touched in the current APA regulation that was issued in March. The challenge would be for taxpayers that choose to adopt the TNMM for their APA, where true up, true down adjustment is related to export and import transaction that would attract duties. Why? Because true up, true down adjustment was actually done at year end, while the current Indonesian import and export system only provides a 3-day window to revise your export or import declaration documents. Until now, there has not been any clarity issued by the tax office. So this could be a material issue for taxpayers who adopt true-up and true-down adjustment, because the authority to conclude APA is with the International Taxation Unit within the Directorate General of Taxation. While for VAT, excise tax, duties is handled by a different unit. So, the differences in approach between the two units, you really need to manage. And for this, I would suggest that you quickly initiate a consultation session with both units. First, maybe you go to international taxation who authorize your APA, and then second, get an agreement on how to approach it with the VAT unit. That's all for Indonesia, Zara.
Thanks, Michelle. And I think you raise a really important point in the conflict, the ongoing conflict between transfer pricing and customs duty, and the importance of managing it. So where there are significant adjustments made as a result of COVID, for example, of course, taxpayers shouldn't overlook the flow-on and consequences from a customs duty perspective and a VAT perspective. In many countries, customs authorities will seek additional duty where there is additional duty payable. With an increase in pricing. What we're mainly going to be talking about here, of course, is a reduction in prices to increase the profitability or reduce the loss profile of the local entity. And many tax authorities, customs authorities will not give refunds, or if they do give refunds, they're very complex administrative processes in achieving those refunds. So this is the importance of trying to manage it as you go throughout the year as well, rather than having massive end of year adjustments. So for those listeners that haven't actually made many adjustments to date, according to the poll, this is certainly something to watch out for. Elise, do you have a tip that you'd like to share?
Just a quick one. So I think it's absolutely necessary for taxpayers to consider whether or not their businesses have been impacted by COVID, whether the policies that they have changed or need to change, and more importantly, whether adjustments need to be made in time for year end. So over here, the IRS has affirmed that proactive adjustments to the arm's length conditions are expected. So it will be important for companies to document their positions early on. Yeah. That's all from me, Zara.
Thank you, Elise. Diego, a quick 1 or 2 tips from you?
Sure. I think, Zara, practically, and this is more around year end. So if we talk of, how the group has been reacting, we've seen, changes being implemented across the group, and group level profitability being impacted. So I would advise the taxpayers the parent entity to quantify the economic impact and share it with the group entity so that they could include it in their documentation. Apart from the routine, which generally you do, try and do segmental, try and do your analysis of what are the abnormal costs which are on account of COVID. Try and do a corroborative benchmarking. See if you can get quarterly results from the listed entities, and try and see if you can benchmark them. And of course, when you talk of financial arrangements, whether they need to be adjusted. So that's a few things that I would advise. One important thing, in fact, is emphasis in the factual disclosures in the financial statements. The more accurately and more broadly you are able to disclose it, the better chances you will have to justify your claim before the tax authority.
Thanks, Diego. I mean, we could talk about this for hours, couldn't we? Because there's so much that you need to do in terms of financial analysis, economic analysis, and make sure that you have the evidence and support to be able to present to the tax authorities when they come. Probably not if, but more likely when they come. So it's a whole topic in itself. Enoch, have you got a housekeeping tip you'd like to share?
I think it's exactly the same as everybody was talking about it. It's very practical. It's going to be documentation. how to build your defense file. One thing that I want to raise is in China, there's one section in the transfer pricing documentation local file is value chain analysis. I think it would be great if we are going to do any changes or any movement in our TP policy, value chain analysis, the entire value chain, why movements are being made, why changes are being made. These are important things.
Enoch, thank you for providing the segue into our next topic. I think that's absolutely right. So there was one question that I was going to address, but I think that the panel has addressed it. There was a question around whether any specific TP docs are required to reflect changes in the business. And I think everyone's commented on the need for, most importantly, a whole lot of analysis to support changes in the business in any situation, but particularly in response to COVID. So let's turn to global value chain and supply chain being a subset of, I guess, looking at global value chains. So business restructuring and rethinking the efficiency and effectiveness of supply chains in the current environment is really a key topic. So COVID has revealed vulnerabilities in a lot of businesses' supply chains. We have international trade disputes. We have a lot of geopolitical issues going on. We have a US election result, or do we? You know, we've got a lot of complexity in the world, not just with COVID. So that all makes it really difficult for companies to manage their supply chains. And COVID has shown how reliant many businesses are on one or two suppliers, whether it be in China or anywhere in the world. The way that businesses have conducted themselves globally has often been, you know, with limited suppliers, whether that be materials or finished goods. So, and a lot of businesses have been caught out and never want to be caught out that way again. So, Kate, could we just quickly bring up the polling question, which is about rethinking changes to current business models? And then I'm just going to ask each of the panel members to make one comment on each, so we leave a couple of minutes for digital services tax at the end. So here's a quick polling question. Are you rethinking changes to your current business model as a result of COVID? So please respond. No significant changes anticipated. Yes, you're making changes, or you're still thinking about it. So if you could please respond, we'll give you 10 seconds. Okay, let's bring the results up. Kate, please. Okay, so it looks like, what's that, nearly 70% are either still thinking about it or not making any changes. So a third of you are making changes. It's quite an interesting statistic, and I think it varies a lot by region. So I'll be interested to see the Americas response when we get that one through. Thank you, Kate. Because the EMEA response, 54% of clients responded saying that they are still determining whether changes are required, and only 26% said they're making changes. So 26, 33, you know, pretty very similar. So a third are underway. I think that's going to be very different looking at the Americas. I think it's going to be the other way around. 50% or more US multinationals are making a lot of changes at the moment. So there is a lot of focus on supply chain restructuring. Enoch, maybe if I could start with you. You know, Hong Kong, China, important region, will continue to be an important region into the future, but obviously a fair bit of disruption from a supplier perspective. Can you share with us some insights, what companies are doing in China, or what some of your observations are for your region?
Sure. Yeah, indeed, lots of disruptions, but also, you know, in China there was a quick resumption of the business. So several insight or observations from China, Hong Kong, both from a supply side as well as from a demand side, because, you know, all of these, most of my clients said that they do not need, or there's no plan to do any restructuring. But then when we're talking about the specific issues they're facing, that actually is an implicit restructuring. For instance, after business resumed in China in the summer, a lot of the suppliers and manufacturers in China, they face, you know, they lost lots of purchase orders from overseas. The ports are locked down, the economy is locked down. Supply chain in these suppliers basically needs to restructure, you know, because they need to turn from overseas into domestics, especially in China. So in building, rebuilding, reestablishing the customers' relations, sales, marketing efforts, some of these things, they need to reshuffle their supply chain within the organization. On the demand side, because of the suppliers, because of the border lockdown, I see a lot of the logistics businesses in Hong Kong. They cannot go into the factories to do on-site testing, quality control. All of these things actually makes their sales dwindle as well. So the supply chain of many of these suppliers or many of these service providers, they are impacted by COVID, and they need to look at new ways to restructure in a certain manner to look at how to rebuild the business.
Thanks, Enoch. Jigar, from an Indian perspective, obviously also very high manufacturing environment. What are your observations?
Yeah, I think Zara, India has always been attracting foreign direct investment in manufacturing. In fact, now all the more so. Recently, the government has announced beneficial tax rates for entities setting up manufacturing in India. Of course, this was not targeted as a result of just COVID. This was even a pre-COVID announcement. But yeah, as a result of COVID, many of the entities which are manufacturing currently in China are looking at India as an alternative base. So yes, they are looking at setting up base. On the other way around, when you're looking at captives or limited risk distributors, I think the MNEs are looking to restructure their value chains to see whether this risk-free entities can be allotted some risks. And I think when any kind of changes are being made to a supply chain or value chain, it's important to note that there are tax implications that you need to be mindful of. Whether should there be an entry charge or exit charge in your system? Does this really mean a business restructuring? Are there loss of profits which have to be accounted for? So these are few things that clients need to be mindful of.
Thanks, Jigar. I think one of the other interesting questions is a slow migration over time. So not necessarily an immediate, stop in one jurisdiction and start in another, but a migration from jurisdiction A to jurisdiction B. And some tax authorities are, concerned about that in the sense that you're not triggering perhaps a tax event, but you're actually giving rise to an economic outcome, which means a reduction in profit in one jurisdiction over the long term, which is not necessarily easily captured under the tax laws. So the tax authorities are very, very aware of what is happening from a commercial perspective, but what are the flow on tax consequences? In some cases there's opportunities to optimize and plan and get a better outcome. But in other cases, as you say, Jigar, there are tax consequences that need to be thought through so you don't accidentally trip up on those. I'm going to turn to Singapore, and I am conscious of the time, so I will just say to our participants, I think we will run 5 minutes over because I'd like to spend the last 5 minutes just talking about the digital service tax regimes, not the digital economy as in Pillar 1, Pillar 2, but digital service tax, because I think that's a bit of a sleeper that people aren't aware of. So I think just a forewarning, apologies, but also bear with us. I think we'll just extend by 5 minutes. So maybe just on supply chain, some comments, Elise, from you. So Singapore particularly has been an important country in the region and has been a regional hub for many multinationals. What do you see as some of the major issues or opportunities with what's been happening, not just as a result of COVID?
Yeah, I think we can all agree that it's now more competitive in attracting the investment dollar. And the Singapore government has really tried to up the game by introducing new incentives and grants to attract and retain businesses. So they're not just targeting MNCs, they're also targeting private wealth plans and also even startups. So at my end, I do see a little bit of renewed interest in sales and procurement hubs in Singapore. And this part of this is because of the trade wars that have happened, and then COVID. So some MNC groups, they are looking to diversify their supplies. So just yesterday, I met with this son who wanted to start a logistics hub here in Singapore because their customers were having difficulty buying from China. So they wanted to access alternative supplies in the Southeast Asia. Yeah, so there's definitely some changes that might happen. Yeah.
It's interesting, Elise. I think even Australia would see itself as a competitor in the region now. I mean, we have a high tax rate, so we're a highly taxed jurisdiction. But in response to COVID, creating jobs, creating investment in Australia, etc., looking for ways to attract investment, there's certainly a lot of multinationals that are less comfortable with investments in Hong Kong, with the Hong Kong links with China, of course, we know that. So I think there's a lot of countries in the region that are trying to take advantage of that and leverage that for the benefit of their own economies, Australia included, even though we have a high tax jurisdiction. So, you know, the question arises, is the sophistication and other benefits in Australia going to be appealing to multinationals to actually, you know, park themselves in Australia as a regional hub or as a footprint between the region and the rest of the world? So I think we've got a very, very different environment now. Michelle, is there anything that you wanted to add before we move into talking about digital services tax? No?
Maybe I can add something to that. 2 minutes. Okay, Malaysia, we just had our new budget 2021 announced last Friday. And what's interesting is that the government has announced that there will be a major shakeup of our tax incentive system in Malaysia. So I think that follows on from your question, Zara. There, you know, a lot of authorities in this region, governments will be fighting for new investments to come into our countries. So that's over from Malaysia. Thank you, Zara.
Thank you. Yes, no, it's healthy competition across the region, so we look forward to that. And, you know, I think that actually creates opportunities for a number of businesses, a number of countries, and a number of people. So, okay, let's move into our last segment, and we'll only spend a very brief amount of time on this. So taxing the digital economy, is it coming? Is it already here? We're already seeing the expansion of the types of businesses caught under the, you know, digital tax, OECD proposed digital tax under Pillar 1, Pillar 2. With the impact of COVID, of course, we're seeing a lot of businesses having to either permanently or temporarily close their bricks and mortar outlets, and therefore moving more onto online channels to market, of course, to survive. So perhaps taxing the digital economy is going to be more important in the future, and perhaps there is going to be more pressure on governments and the OECD to reach agreement. I know Australia is very heavily dependent on direct tax rather than indirect tax, but Australia, for example, has already said, no, we're not introducing any digital services taxes. We're going to wait until we have a unified approach from the OECD, despite the, you know, the revenue costs. So, Diego, can I ask you just to share some comments and maybe just a brief update in terms of what the digital services tax regime is looking like, because I think there's a lot more countries that have either implemented or are implementing than what a lot of people realise, and I think it's a little bit of a sleeper.
Yeah. Thanks, Zara. I think, in fact, not an exact number, but around 25% of countries across the globe introduced digital services tax or are likely to introduce digital services tax. And if you look at digital services tax, it's in different forms. Sometimes you don't realize that this is indeed a different tax which is introduced. So in a lot of countries, they've already introduced it as a separate tax. So India calls it equalization levy. Some of the countries call it digital services tax. Some of them call it a digital tax or a Google tax, which is actually, whether it's actually a debate whether it's a direct tax or an indirect tax. But again, be there as it may. That is taxing automated digital services, some form of online sales or e-commerce transactions. At the same time, there are other measures like withholding taxes, including in VAT on a reverse charge mechanism for online digital services. Some countries have introduced concepts like significant economic presence, which would constitute residence or permanent establishment if you have beyond a threshold of users in your country. And mind you, I think the challenge always is that do you get a credit for it in the country which is actually earning this income of the taxes that have been paid in the source country? Most of the times not, because these are not naturally forming part of the tax laws. Like for example, Indian equalization levy is a separate levy. It is not part of the Indian income tax law. So there is no question of any credit being allowed under DTAA. So I think all in all, what is happening is, there are taxes which are being introduced in various countries. Number of them impacting not their residents, but mostly non-residents. Some of them, in fact, even requiring the non-residents to register, obtain a taxable registration in the market-facing country and pay taxes over there. So obligation is also cast on non-resident and not just resident. So I would say, that countries need to be mindful. There is an increased tax cost. There could be increased cost of doing business, not to mention the additional compliances. And if you fail, the wrath of the government, who's already hungry for revenue. I think during the COVID period itself, not less than 30 countries have introduced digital services tax just to recoup, the loss of revenue. So that is broadly on the digital services tax, Zara.
Thanks, Jigar. And I might just add that BDO has developed a tool that identifies the number of countries that have introduced or are introducing digital services tax. So if anyone's interested in seeing that tool, reach out to one of us or go onto the bdoglobal.com website, and you can see that tool and see the status of the digital service regimes and when they're being implemented, because the numbers are quite frightening, I think. So
Zara, in fact, that's a interactive map. So you point at the country and the announcements come up.
Yes, yeah, it's really cool. Elise, what is Singapore doing in this context?
Well, in Singapore, digital tax takes the form of goods and services tax. So in Singapore, the GST was only introduced in 1994. So it's quite a new regime. And from this year, January of this year, offshore vendors that sell digital services online would have to register with the IRS and pay GST on what they earn. So it's similar to what Peter has mentioned, whereby the onus is on the offshore vendor to register and pay the tax. Yeah.
Thanks, Elise. Bernice, I know Malaysia is particularly keen on this. Any comments from you?
Yeah, obviously, Malaysia is going to be a beneficiary of the digital tax. We have withholding tax on digital advertising services, and we also have service tax on digital services. So we wait to see whether or not this will be expanded in the next year or so. Thank you.
Thank you. Michelle, Indonesia, top priority?
Yep, same as India and many other countries, digital tax is also a top priority for Indonesia. Although the current taxing system will still need more work to address certain areas. So this year, the government has enacted law number 2, which is to initiate tax policy on e-commerce. So this is one step ahead for Indonesia for the first time. For income tax, the law authorizes the Director General of Taxes to treat an offshore supplier that has a significant economic presence in Indonesia as having a permanent establishment. But however, Indonesia's existing tax treaties rely on physical presence and do not yet recognize the significant economic presence concept, which essentially would make the law ineffective. The second controversy is also that the law introduced a new type of tax similar to India, which is the electronic transaction tax that we call it. for taxing business profits of offshore supplier located in jurisdiction in Indonesia tax treaty partners. Now, because the electronic transaction tax is outside the scope of tax treaty, similar to what Jager has mentioned earlier, it is non-creditable in the supplier's country of residence and could potentially raise the issue of double taxation. So a current challenge is also faced, that is by taxpayer, is to educate the tax authority on how the digital economy operates, the business model, understand the business, how the value chain works, and how monetization of different services work. Indonesia tax policy makers are also very active in the OECD forum and also other international tax forum. So I think it would not be too long for Indonesia to be in equal footing with other countries. Back to you, Zara.
Thanks, Michelle. Enoch, anything on China, Hong Kong?
Hong Kong, no, not a whole lot. China, the VAT reform had already been, in place and include a lot of the online sales and activities, but it has not been, enough to include a lot of the B2C and C2C activities. So the STA, they are looking at doing a more full encompassing regime on the VAT to look at the digital economy. So this is going to be forthcoming.
Thanks, Enoch. I mean, I think the observation here and the concern is that there's potentially double tax, triple tax, a lot of complexity, high compliance burden, whether we're talking about Pillar 1, Pillar 2 under the OECD model, or whether we're talking about unilateral digital service tax regimes. I think the other concern is the longer it takes for unified agreement at an OECD level, the more countries will introduce their own unilateral arrangements in response to COVID and everything else that's been going on. They won't be able to wait. And I think the timing at the moment is it's at least 2 years away before we're likely to see implementation of any sort of digital taxation of the digital economy. So it's really hard to keep track of all of these regimes. And of course, all of the rules are different country by country. And so I would encourage participants to really try to get your heads around this. I think it's a genuine sleeper, and I don't think there is much awareness. There is as much awareness out there about this sleeper as what there needs to be. I'd like to draw the webinar to a close. I'd like to say thank you very much to our panel, and particularly thank you very much to all our participants who've joined us and who've allowed us to go quite a few minutes over. So thank you for bearing with us, because I said that the numbers are still high. We really hope that you've enjoyed this. Of course, these topics we could spend, an afternoon on, if not a day. So we tried to pick the topics that are of most interest to you. You will receive a feedback request from us after the event, after the series of events, and we would encourage you please to share your feedback, because we really want to make sure we're aiming at the right topics and hitting the right mark for you as our audience, our participants. So thank you so much for joining us today. You will receive some slides, recording, etc. Hope that you can enjoy the Americas one as well if you're interested. And of course, if you do have any follow-up queries or questions, feel free to reach out to any one of your panelists today. So I wish you well. Thank you so much, and enjoy the rest of your day, all of you. Goodbye from BDO.
Thank you.